if the 125 high from July was really the top, it was extraordinary in a sense that it didn't have the associated euphoria in a lot of the metrics that I look at, which I think are important for identifying tops in Bitcoin. And so if that is, and if I'm wrong, then what we've got here is a distributive, sort of a distribution top, which is slower and sort of more moderated because we didn't have the parabolic move at the end of the bull cycle that we've seen in the previous cycles. So the Bitcoin cycle risk score does look to capture those sort of factors which are, non-liquidity. Well, there's a liquidity element to it, but
Bitcoin's latest rally has reignited the bulls, and according to Jamie Coutts of Bloomberg Intelligence, the real fuel for its next breakout may come not from hype, but from the dollar and global liquidity. Jamie Coutts, senior market strategist at Bloomberg Intelligence, notes that Bitcoin's rally to $116,800 has renewed speculation about a potential move toward $130,000. While Q4 is often a strong seasonal period for crypto, he emphasizes that the real catalyst for Bitcoin's next move lies in the US dollar and global liquidity. Central bank rate cuts provide some support, but Coutts argues that balance sheet expansion and dollar movements exert a far greater influence on asset prices. Earlier this year, the US dollar index, DXY, saw one of its sharpest multi-quarter declines in decades, fueling a surge across risk assets, including Bitcoin. Currently, the DXY is consolidating around 98 to 99, and Coutts believes its next move will be decisive. A further decline, driven by rate cuts and policies aimed at weakening the dollar, could spark another leg higher for Bitcoin in Q4. Coutts also underscores the importance of global liquidity, which includes central bank balance sheets, FX reserves, and the shadow banking system. Historically, rising liquidity flows into sensitive assets like tech and crypto. Institutional demand is reinforcing this trend, with ETFs seeing $947 million in inflows over just a few days. Despite softer stablecoin flows, these inflows highlight strong investor appetite, positioning Bitcoin for a potential breakout. The crypto market's next big surge is coming. Subscribe and turn on notifications to be there when the breakout happens.
Generally, Q4 is seasonally a good period for Bitcoin and crypto. But like seasonality, those seasonality charts are pretty sort of dicey as well in terms of just like trying to look at them as sort of some sort of guide. But generally, Q4 and Q1 are strong for crypto in general. It all really depends on the dollar. The dollar's the massive swing factor here because central banks, although they're cutting in terms of interest rates, which is liquidity positive, but really only at the margin. It doesn't make a massive difference to asset prices. It does to the business cycle, which has a knock-on effect for capital expenditure and consumer spending. So it's generally all very, very positive. But without central banks actually expanding their balance sheets, then really what happens with the dollar is the most important thing right now to track. So I just constantly look at what the DXY is doing. The DXY had one of the largest declines in Q1, Q2, and really into Q3 in decades. And that's the reason why I think even on, the last time I was on the show, John, was one of the main reasons I published like the Bullish Trinity report, at the start of April saying, I think risk assets and crypto are going to go up a lot. Because of that, the speed of that decline was so significant. Now we're seeing the DXY sort of hold around sort of 90, 98, 99. It really matters. The next leg of that move, whether it's a retest of 101 or a breakdown below, will, I think, be incredibly important for risk assets. My view is that we'll probably test around 100. And so it might be a couple more weeks of chop. But eventually with interest rate cuts and what Trump is trying to do with best interest to try and bring the dollar down, that there is another leg lower. And so at some stage in Q4, maybe in November, we'll start to see crypto start to really catch a bid again. But, there's probably some assets that are worth buying right now with a view to the next sort of 6 months being particularly good. Yeah, you'd have to be living under a rock not to have seen that chart. But I can't take credit for the chart that I think you're referring to, which is really the chart that Raul and Julian posted a long time ago, which is global M2 with Bitcoin and that divergence where M2 sort of basically, forward looking at there's a lag in the Bitcoin price, but generally with around about a sort of 10 to 12 week sort of lag, Bitcoin generally follows global M2. You're right for pointing out, and thanks for giving the context around it, because one chart on Twitter doesn't tell the whole story. And the work that Julian and Raul do on global liquidity in their product, which is really the GMI product, which is the institutional product, of which Real Vision members get a portion of that within the Pro tier. So all of these charts you're referring to are in the Pro tier, but the work that they have done is second to none. I mean, Michael Howell has obviously been doing it for a lot longer and is amazing. And I would put a lot of my understanding around global liquidity is a result of his work, and also Raul and Julian's. But I just want to talk about Raul and Julian for just a second and not take away from all the other great liquidity analysts that are out there, because the one chart that you're talking about has sort of been passed off, and some of the people aren't attributing it to them, and then they're going and putting their own context on it, and they're not actually looking at the breadth of work that they've done. So what is important in the current market is total global liquidity. We live in a global economy. And so US M2 is just one component, one major component of that. The other thing is that, I guess to answer the question more specifically, is that the TGA, so firstly, I would say when you try to marry correlations exactly within timeframes like that, it's when you start to use it that it'll definitely break. That's just Murphy's Law. But that's not what Raul and Julian were saying. That was just one chart that they put up. Total global liquidity is far more important than just US M2. It includes the global central bank balance sheets. It includes the money supply of other markets. It includes FX reserves. And there's other factors which go into looking at collateral levels in the shadow banking market. Importantly here, the TGA, the US government's checking account, essentially, which sits at the Fed, which is most likely the reason why we've seen that divergence of late. Because in the last couple of months, the US government has been refilling its accounts, been issuing a lot of short-dated bonds or bills. That's been taking liquidity out of the market. That's taken the TGA from around, I think, 200 billion to about 750. So that refilling of their account is liquidity negative. Now that they've reached that level, that liquidity drain is effectively over. And so that could be the reason why Bitcoin has not kept up with, I guess, the global M2 metric. But all of that content and all of that context is over at Real Vision. I would just say that, look, in my analysis is that, I come from a technical analysis and a sort of quantitative systems background. And the relationship between global liquidity and asset prices is exceptional. It's like one of the strongest things that I've ever seen, but that doesn't mean that the R squared or that relationship, that explanatory factor of one on other doesn't wiggle and change over time, because markets are totally non-stationary. But should it matter in the end? 100%, because every extra unit of liquidity or currency that goes in the market finds a home. It generally finds it a home in asset prices. And then you start looking at which asset prices are the most sensitive to the increases in liquidity. And of course, you've got tech, crypto, Bitcoin, some more than others. So, an element of that increase in liquidity finds its way into these assets.
When it comes to Bitcoin's next big move, Jamie Coutts of Bloomberg Intelligence argues that liquidity, not just interest rates, will be the real game changer. Jamie Coutts, senior market strategist at Bloomberg Intelligence, highlights that while interest rate cuts are important for the broader economy, they have a limited impact on driving asset prices compared to central bank balance sheet policies. He explains that cuts can supercharge indicators like the ISM by lifting them above 50, stimulating housing demand through lower borrowing costs and unlocking household equity. Yet for assets like Bitcoin, liquidity created by quantitative easing and balance sheet expansion matters far more than interest rate moves alone. With the Federal Reserve still engaged in quantitative tightening, overall liquidity remains constrained, though Coutts expects future shifts in policy could benefit risk assets, including crypto. He also underscores the role of settlement volumes as a key measure of on-chain activity. These include token transfers, stablecoin flows, decentralized exchange (DEX) volumes, and limited NFT transactions. Data from Ethereum, Solana, and Tron show that settlement activity is scalable, efficient, and characterized by higher velocity than in traditional finance. Unlike fiat systems, where monetary velocity has steadily declined, Bitcoin and crypto demonstrate faster capital circulation, fostering innovation and growth. Overall, lower interest rates typically support higher crypto prices, making the interest rate environment crucial for Bitcoin investors to track. Let's get back to the interview.
I think it's important for financial conditions in the business cycle. So Coutts will, supercharge the ISM and bring it back above 50 and sort of, I think, continue or accelerate the improvement on that end. But I don't think it's as important for like just asset prices in general. I think asset prices respond to more of the quantitative policies from central banks. And at the moment, even though it's marginal, the Federal Reserve is still tightening its balance sheet. They're still conducting QT. So I don't expect them to change. Like we don't have a federal a Fed chief that's, I think, going to, while he's in charge, retire that policy. But it's coming to an end at some point. So, whether it's with the new Fed chair next year, if you just look at the way central bank balance sheets have always clipped major turning points in crypto, I think that's more important than interest rate cuts. But that's not to say that they're not important, because the business cycle needs interest rate cuts. Interest rates are too high relative to the economic growth. They need to bring that down. They want to bring that down, interest rates down, so that they can unlock equity in people's primary asset, and sort of spur economic growth through the property market. So all of these things are definitely positive for crypto, but it's not the good old days of the 2010s where it was QE2, 3, QE infinity, and everything just responded on a dime to those quantitative measures. But I think those policies get retired, and also there's probably another trick up their sleeve with adjusting, like the government adjusting the SLR, the supplemental leverage ratio for banks, so they can increase liquidity into the market through more lending. So that would be, that would directly flow into M2. Yeah, so I hadn't done this analysis really since 2022, and the data providers are getting a lot better with capturing settlement volumes. And settlement volumes in the crypto context means they are tracking, settlement flows which are related to peer-to-peer transfers of the native token on an L1, transfers of any other tokens related to that L1. So on Ethereum, it's ERC20, and on Binance, it's their token protocol. So it basically assets moving on chain, but also peer-to-peer transfers of stablecoins and DEX volumes. There's also NFTs, but NFT volumes are really sort of negligible at this point. So you put them all together and you come up with like total settlement volume. The problem at the moment with this data is that even though the data providers are sort of are scaling it up, when you look across chains outside of Ethereum and Solana, you don't have all the data for all those different activity cohorts, but you get a pretty good proxy. So it probably undercounts. Well, it definitely undercounts total settlement volumes, but most of the volume is actually quite concentrated in Ethereum and Solana and also Tron. And there the data is a lot more comprehensive. So you've got a pretty good proxy. Now, the biggest drivers are DEX volumes, actually, which are, on Ethereum and also on Solana, account for a portion portion of fees. So you could argue, hey, it's just speculative activity. It's degens doing degen stuff. The reason why I did this analysis is that I think it's so important for everyone who's investing in crypto or thinking about investing in crypto, is like, where will we be in the future? So the subjectivity that I experienced when I started working as a crypto research analyst at Bloomberg Intelligence, and you get the sort of sniggly remarks that, this kind of settlement volume is not the same as settlement volume on payment platforms like Visa and MasterCard and PayPal and whatnot. Well, really, what was it showing initially? It was showing that the technology can scale, is far more efficient. The velocity of money that moves inside the crypto economy is magnitudes more than the fiat economy. What is the problem with the fiat economy? Velocity has been declining for decades upon decades, despite the Keynesian economics models and theories saying that they could tweak it through government policy and monetary policy. That has not happened, although we've seen a spike since COVID, but generally that trend has been down. Low or declining monetary velocity in any economy is not good. It shows that capital is not moving. It's not moving into productive use cases. It's not spurring activity and entrepreneurship. In fact, I would argue that the main reason, or one of the reasons that velocity is going down, is because that all new money, or most money, is flowing into investments, not into productive uses, not into the real economy.
Bitcoin's sideways trading may be testing patience, but underlying liquidity signals suggest the market is quietly coiling for its next move. Metrics such as global M2 growth, stablecoin supply, and even correlations with gold are aligning in a way that historically precedes major rallies. While rate cuts can influence sentiment, the deeper driver remains global liquidity flows and the strength of the US dollar. With institutional demand still evident through strong ETF inflows and settlement activity on-chain reflecting high monetary velocity, Bitcoin is well-positioned to capture capital once liquidity conditions ease. Investors who stay focused on liquidity dynamics, rather than just price action, will be better prepared to catch the momentum when the next breakout unfolds. Do you think Bitcoin's next breakout will be driven more by global liquidity shifts or by growing institutional demand through ETFs? Crypto moves fast. Share your thoughts in the comments, spread this with your network, and subscribe to ride the next wave before it hits.